So hey guys, this video is a continuation of my previous video where I have talked about key investment terms for the people who have started their investment journey must know. So if you are new to my channel, my name is Aman and in my channel I break down financial concepts into simplest way possible. So if you are someone who is interested in finance or wants to learn more about the topic, then I believe that this channel might help you. Now without wasting any further time, let's just start today's video. Now the first term that we will be covering in our today's video is PE ratio or price to earnings ratio. So it measures the market valuation of a company relative to its earnings. It tells us how much investors are willing to pay for 1 rupee of the company earnings. And there is a formula for PE ratio which is market price per share by earnings per share. Now higher PE basically indicates that the investors have much more confidence in that given stock and that the stock or maybe that the stock is overvalued. Now similarly, lower PE states that the stock is undervalued or that the stock doesn't have any growth prospects. Now PE ratios are usually used to compare the companies within the same industry, and each industries have their average PE ratio through which the investors compare if the PE ratio is high or low. Now second, we move on to dividend yield. It tells us how much return a shareholder gets in the form of dividend compared to its stock price. Now there is a formula for dividend yield as well, which is annual dividend per share by current share price. Now a higher yield basically indicates that the investors will be getting more of a passive income. Now it may be a sign that the stock price is falling. Now there may be a scenario where there is no yield or maybe a lower yield. Now it indicates that the companies are reinvesting in some other profitable opportunities. Now dividend yield are suitable for investors who are pursuing their retirement or investors who are seeking a steady cash flow. Now third is liquidity. So liquidity basically means that how quickly an asset can be converted into cash without affecting its price. Now it is categorized into 3 types, which is higher liquidity, medium liquidity and lower liquidity. So a higher liquidity asset classes are cash or stock that can be sold in just minutes. A medium liquidity asset classes are mutual fund or ETFs that takes 1 or 3 days to sell. Now a lower liquidity asset classes are artifacts or commodities that may take months or even years to sell. Now liquidity is crucial because it makes sure that we have adequate cash in the times of emergencies. Now similarly, higher liquidity asset classes are crucial for the short-term needs, and a lower liquidity asset class are crucial for long-term wealth building. Fourth is AUM or asset under management. Now it indicates the total market value of all the assets in a particular fund or a portfolio. Now it takes into consideration all types of assets, be it stock, bonds or any type of asset that a fund has. Now a fund with a higher AUM also indicates that investors have much more trust in that particular fund, and it indicates a higher market presence. Now similarly, a fund with a higher AUM also indicates that it has much more liquidity and stability. Now there is a common misconception that investor has is that usually funds with higher AUM means better market return, but it depends upon a lot of external factors, be it the fund strategy or maybe the market conditions. Now investors usually track the trends of the AUM because the AUM with a consistent growth usually indicates that investors have confidence in that particular fund, and it indicates that the fund is performing good. Fifth and the last term for today's video is expense ratio. Now it indicates the total fees which are charged by mutual fund or the ETFs in order to manage your fund. Now it covers your fund manager expenses, administrative cost and even operational cost. Now expense ratios are deducted directly from your investments. Now a lower expense ratio means that more of your savings remain invested. Now investors usually prefers investing in index fund because these are the passive fund, and they are also relatively safe as compared to active funds which have larger expense ratios like 1 to 2.5%. Now that is all with the today's video guys, and if you want to check out the previous videos, then I put the link down below in the description. And if you found this video insightful, then I would appreciate if you just like and subscribe and follow for more such finance related content. Till then, see ya, stay tuned.